You know, it's crazy how quickly things can change in the financial world.
Yeah, absolutely. Wild swings, sometimes fortunes made and lost overnight.
Right. And today we're digging into one of those unbelievable stories, the rise and fall of FTX.
A company valued at $32 billion, dollars,
32 billion with a B.
gone practically in the blink of an eye.
Poof.
It's being called the biggest scandal to ever hit the crypto world.
And when you hear how it all happened, you'll be amazed.
Amazed and maybe a little horrified.
For sure. So we've been poring over tons of articles about FTX, trying to piece together this whole saga.
Their history, their collapse, the whole 9 yards.
Exactly. And we want to break down the most important parts for you so you get the whole picture of how this could even happen and what it means for the future.
What are the lessons learned? Because there are a lot of them.
So FTX was founded in May 2019 by Sam Bankman-Fried, often just called SBF, and Gary Wang, who used to be a Google engineer.
Right, but the story really starts even earlier than that with SBF's first company, Alameda Research.
Alameda Research, which he started in 2017.
Yeah, and it was all about taking advantage of the different prices of Bitcoin in different markets around the world.
So buying low in one place and selling high in another.
Exactly. Arbitrage is what they call it.
Yeah.
And it was a pretty low-risk way to make some serious cash.
And that early success gave SBF the money and the reputation to launch FTX as a new kind of cryptocurrency exchange.
He was seen as a bit of a whiz kid, already making waves in the crypto world.
And FTX quickly gained a ton of users.
It became incredibly popular, and for good reason.
What made it so appealing in a market that was already pretty crowded?
Well, they made it really easy to use, which was huge for people who were new to crypto.
Yeah, the interface was super user-friendly. Even I remember thinking that at the time.
But they didn't stop there. They also had some really advanced trading features for the pros.
Right, so they appealed to both the newbies and the experienced traders.
They really wanted to be a one-stop shop for everything crypto.
And they offered a wider range of cryptocurrencies than most other exchanges.
Plus, they were constantly innovating, coming up with new products like crypto derivatives, leveraged tokens, and futures contracts.
It sounds like they were trying to cover all their bases.
Absolutely. And then came the crypto boom of 2020 and 2021, and FTX just exploded in popularity.
Their growth was insane. It seemed like you couldn't go anywhere without hearing about FTX.
It was remarkable. By early 2022, they were the second largest crypto exchange globally, right behind Binance.
And they were valued at around $30 billion, which is just mind-blowing.
Especially considering they'd only been around for a few years.
And they were everywhere. The FTX Arena in Miami, that Super Bowl commercial with Larry David.
They really went all out with their marketing. High-profile sponsorships, celebrity endorsements, you name it.
Oh yeah, the celebrity endorsements.
Tom Brady, Steph Curry, a bunch of A-listers.
I bet some of them are regretting that now.
You think? I mean, it was all over the news how FTX just completely imploded.
But at the time, FTX seemed like a sure thing. Even major venture capital firms were pouring money into it.
Like Sequoia Capital and SoftBank. Those are some of the biggest names in venture capital.
So it wasn't just everyday people getting caught up in the hype. Even the big institutions were buying into the FTX dream.
And a lot of that hype was built around the persona of Sam Bankman-Fried, SBF.
He was on the cover of magazines, being hailed as the next big thing in finance.
It was almost like a cult of personality had developed around him.
It's easy to see why. MIT grad, former Wall Street trader, he was seen as a genius, a visionary.
And he had this whole image, too. Super smart, but humble.
Always in shorts and a t-shirt.
Like he was too busy thinking big thoughts to care about appearances.
Right. And he was also very public about his philanthropy.
Effective altruism, he called it.
Pledging a huge chunk of his wealth to charitable causes.
Things like global health and pandemic prevention.
It made him seem like he was in it for more than just the money.
And he was very vocal about working with regulators and politicians, trying to position himself as a responsible leader in the crypto space.
So you had this image of SBF as this brilliant, trustworthy, and altruistic guy, and that image really rubbed off on FTX.
People felt like they could trust FTX because they trusted SBF.
And that's what makes what actually happened so shocking.
Because while FTX was projecting this image of stability and ethical leadership,
The reality was far more sinister.
there was rampant mismanagement, reckless risk-taking, and a blatant misuse of customer funds.
And at the heart of it all was this really close relationship between FTX and Alameda Research.
So close that the lines were completely blurred.
They were supposed to be separate entities, but they were anything but.
FTX was secretly funneling customer money to Alameda, which was using it for all sorts of risky bets.
That's like taking money from your savings account to gamble in Vegas.
It's a huge no-no in the financial world. Commingling of funds, it's called.
It's a complete betrayal of trust.
And it gets worse. Alameda had special trading privileges on FTX.
Like-
They had an unlimited line of credit, could have a negative balance of up to $65 billion in customer funds without putting up any collateral.
$65 billion. That's an insane amount of money.
It's mind-boggling.
And they were using this money for venture investments, loans to other crypto firms, just wildly speculative trading.
All with money that people had deposited on FTX, thinking it was safe.
And then the crypto market crashed in 2022.
And Alameda lost a ton of money, blowing a massive hole in FTX's balance sheet.
Which is when they brought in John J. Ray III to clean up the mess.
The guy who handled the Enron bankruptcy?
He's seen a lot of corporate disasters, but even he was shocked by what he found at FTX.
He said he'd never in my career seen such a complete failure of corporate controls and such a complete absence of trustworthy financial information.
No proper audits, no real record keeping.
They were approving expenses and loans with emoji reactions in chat rooms.
Billions of dollars being moved around with no oversight.
It was like a bunch of kids playing with Monopoly money.
It turned out that FTX had diverted about $10 billion in client funds to prop up Alameda.
And executives, including SBF himself, had taken out over $1.5 billion in personal loans from those customer funds.
They were living the high life, buying luxury real estate, private jets.
And funding those celebrity endorsement deals.
All with other people's money.
It was a house of cards, and it was only a matter of time before it all came crashing down.
And crash it did in November of 2022.
It was a stunningly fast collapse.
It all started with a report by CoinDesk on November 2nd.
They got hold of a leaked balance sheet from Alameda.
And it showed that a huge chunk of their assets was in FTX's own token, FTT.
Which is super risky because if the price of FTT tanked, so would Alameda and potentially FTX too.
And then on November 6th, Binance CEO CZ announced they were selling all their FTT holdings.
Which was like $529 million worth.
And that set off a panic. The price of FTT plummeted.
People started freaking out and tried to withdraw their money from FTX.
Is a classic bank run.
By November 7th, FTX had something like $6 billion in withdrawal requests.
But they didn't have the money to cover it.
SBF tried to calm everyone down on Twitter, saying FTX is fine.
But behind the scenes, they were desperately searching for a bailout. Then came the news that Binance was considering acquiring FTX.
It was announced on November 8th.
For a moment, it seemed like FTX might be saved.
But then, on November 9th, Binance pulled out of the deal.
They said they were concerned about the mishandling of customer funds and potential regulatory issues.
That was the final nail in the coffin.
With Binance out of the picture, it was clear that FTX was doomed.
Withdrawals were still frozen, the price of FTT was basically zero, and the whole crypto market was in turmoil.
On November 10th, regulators in the Bahamas froze FTX's assets, and SBF admitted they couldn't meet the withdrawal demands.
There were rumors of an $8 billion shortfall.
And on November 11th, FTX filed for bankruptcy.
SBF resigned, and John J. Ray III took over.
SBF apologized on Twitter, saying, "I'm sorry I fed up." But that wasn't much comfort to the millions of people who had lost their money.
It was a stunning downfall, all happening in just 9 days.
And the fallout has been huge.
It's been a whirlwind of legal action and regulatory scrutiny.
In December 2022, SBF was arrested in the Bahamas at the request of the U.S. government.
He was extradited to the U.S. and charged with wire fraud, securities fraud, money laundering, and campaign finance violations.
And he wasn't alone. The SEC and CFTC also filed civil charges.
They accused him of defrauding investors and misusing billions of dollars in customer funds.
2 of his top lieutenants, Caroline Ellison and Gary Wang, pleaded guilty to fraud and testified against him.
It was a huge betrayal.
The trial took place in late 2023, and SBF was found guilty on all counts.
In March of this year, he was sentenced to 25 years in prison and ordered to pay restitution, which could be as high as $11 billion.
It's a stunning fall from grace for someone who was once seen as a crypto prodigy.
And it's had a major impact on the crypto industry as a whole.
The collapse of FTX has really fueled the debate about crypto regulation.
Lawmakers in Washington are pushing for stricter rules to prevent something like this from happening again.
They want to regulate crypto custodians, make sure customer funds are kept separate, require regular audits, and make sure exchanges have enough capital reserves.
And the SEC and CFTC have definitely been cracking down on other crypto companies too.
Globally, there's been a push for more oversight and consumer protection in the crypto market.
Like the EU's MiCA regulation, which was approved last year.
FTX really served as a wake-up call for regulators around the world.
It showed that the crypto market can't be left to police itself.
So what does the future hold for crypto after the FTX debacle?
Well, initially there was a lot of fear that it would be the end of crypto.
Like a Lehman Brothers moment that would bring the whole system down.
And there was definitely an immediate impact. Crypto prices plummeted, and a lot of people lost faith in centralized exchanges.
Several FTX-linked companies went bankrupt, like BlockFi.
And others, like Genesis, struggled to stay afloat.
It created a real credit crunch in the crypto space.
But the crypto market is resilient, and it's starting to recover.
Bitcoin has rebounded significantly, and there's renewed interest in crypto investments.
So FTX was a major setback, but it didn't kill crypto.
It did, however, highlight some really important lessons for investors.
Like, don't put all your eggs in one basket.
Don't keep all your crypto on a single exchange.
Diversify your holdings and use personal wallets for long-term storage.
And remember, not your keys, not your coins.
If you don't control your private keys, you don't really own your crypto.
And do your due diligence.
Don't just blindly trust a company because it has a flashy website or celebrity endorsements.
Research the team, understand the business model, look for red flags.
Be wary of promises of unrealistic returns.
And demand transparency.
Look for companies that are open about their operations and finances.
Those that conduct regular audits and publish proof of reserves.
And if something seems too good to be true, it probably is.
FTX should serve as a reminder that even in the exciting world of crypto, basic investment principles still apply.
Don't get caught up in the hype, and always be skeptical.
So the FTX saga is a cautionary tale of epic proportions.
It's a story of ambition, deception, and the dangers of unchecked power.
It shows how quickly a seemingly invincible company can collapse when it's built on a foundation of lies.
And it's a reminder that trust, transparency, and accountability are essential, even in the world of digital assets.
The future of crypto will depend on whether the industry can learn from the mistakes of FTX.
And whether investors can be more discerning and demand greater accountability from the companies they entrust with their money.
It's a fascinating and sobering story.
And one that will undoubtedly continue to shape the future of finance for years to come.
It really makes you think about where we place our trust in this increasingly digital world.
And what steps we need to take to protect ourselves from those who would seek to exploit that trust for their own gain.
It's a conversation that we need to keep having.
For sure. The stakes are high, and the lessons from FTX are too important to ignore.
That's a great point to end on. Thanks for joining us today.
It was my pleasure.
And to all our listeners, stay informed, stay vigilant, and as always, do your own research.